In this next segment, we discuss methods to reduce your trading losses, as well as strategies to exit your profitable trades. An important part of your system is knowing when it is not working. Your protective stop loss is that part of your system that tells you when to get out of a trade in order to protect your capital. It's that point at which you should get out in order to preserve capital, because your idea does not seem to be working. This initial stop loss has to be meaningful, based on your objectives, trading concept, as well as your personality. Also, this stop loss point should be determined even before you execute your trade. We term this initial stop loss, or risk, as 1R. Keep this definition, 1R, in mind as it will be used in a later segment. The following are the various commonly used stop loss methods. For dollar stops, you figure out how much you are willing to lose on a trade, and set that as a stop beforehand. In the second method, percentage retracement, traders set stops by allowing the price to retrace a certain percentage of the entry price. Volatility stops are based upon the assumption that the volatility, to some extent, represents noise in the market. Consequently, if you set a stop at some multiple of the average true range, then you probably have a good stop that is beyond the immediate noise of the market. For the fourth method, if you have a normal distribution of prices, then one standard deviation of price change in either direction would account for about 67% of the prices. Two standard deviations will encompass about 97% of the prices. Standard deviation of the average true range to be quite useful as a stop. For method 5 and 6, just as the channel breakout and moving average concepts can be used as entries, they can also be used as stops. For support and resistance, the trader will enter the market and look for areas of support and resistance on the chart. Stops will typically be placed at the extremes of these levels. Lastly, many traders and investors say that if a position does not go in your favor fairly quickly, then it probably will not. As a result, another common stop-loss method is the time stop. The time stop simply takes you out of a position after a fixed amount of time if you haven't made a profit. Earlier, we discussed stop-loss levels, and how they are determined before you enter a trade. Now let's move on to the scenario where you are already in the trade. The question you will be asking is, when do you get out of the trade? There are three broad categories to the major exit strategies, namely, exits that produce a loss, but reduce your initial risk. Exits that maximize your profits. And exits that keep you from giving back too much profit. We will be going through examples for each category. Your initial stop loss, discussed earlier, was designed to be your worst-case loss that protects your capital. However, this class of exit will also produce a loss, but these exits are designed to make sure you lose as little as possible. Generally, people enter the market because they expect the price to move in their favor shortly after entry. As a result, if you have a meaningful entry signal, then a potentially useful exit is one that will get you out after a period of time when you are not profitable. Such an exit would cause one to lose money, but not as much as if one's worst-case stop were hit. The trailing stop is one that is adjusted on a periodic basis according to some sort of mathematical algorithm. Thus, if the market moves against you enough to stop you out, you would still take a loss, but it would not be as big as your initial 1R stop. In order to maximize your profits, let them run, you must be willing to give some of them back. In fact, the ironic part of system design is if you want to maximize profits, you must be willing to give back a great deal of the profits you have already accumulated. A trailing stop is an exit level that trails the price of the asset. For example, for the channel breakout trailing stop, you might decide to sell if the price hits the low of the last 20 days. As the price moves in your favor, this number is always adjusted in your favor. Profit and percent retracements basically allows profit and price to retrace by a certain amount, on one hand giving them room to grow, and on the other hand locking in some profit. If you are managing other people's money, it is more important to minimize drawdowns than it is to produce large returns. As a result, you might want to consider exits that keep you from giving back too much profit. Some people use trading systems, such as Elliott waves, that tend to predict profit targets. If you use such a system, then you probably can target specific objectives. If you can achieve that, then you might want to take your profit. One of the best exits you can have is a large volatility move against you. What you need to do is keep track of the average true range. When the market makes an abnormally large move, let's say 2 times the average daily volatility, against you, you would exit the market. Some traders like to use parabolic stops. The parabolic curve starts out at a previous low point and has an accelerating factor in upward moving markets. As the market trends, it gets closer and closer to the price. Thus, it does a great job of locking in profits. Now that you understand stop losses and exit strategies, let's move on to numerous other topics from AsiaPacFinance.com.